I frequently encounter the question, should one allocate funds to individual stocks or ETFs? There appears to be widespread confusion regarding the optimal investment approach. Many individuals argue that stocks pose too much risk, suggesting reliance on a manager or investment in mutual funds. I aim to not only explain the fundamentals of both ETFs and stocks, but also explore the advantages and disadvantages associated with each. By the conclusion of this video, I will furnish you with guidance on how to invest your money based on your specific needs and goals. Let's address a key point right from the start. An ETF, or exchange-traded fund, is tradable much like an individual stock, complete with its own ticker symbol. Conversely, a stock represents ownership in a business, signifying a share of the company. When you invest in a company's stock, you become a partial owner of that particular business. In the case of an ETF, it comprises a collection of various companies bundled into a single fund. Essentially, you still hold a share in ownership, but this time it encompasses multiple companies in smaller proportions. Typically, stocks within an ETF belong to a specific industry sector or an overall index. Let's delve further into this. An industry ETF, such as the US Global Jets ETF, JETS, comprises an aggregate of airline stocks from companies like Delta, United, and Southwest Airlines. A sector ETF, like the S&P Technology Select Sector ETF, XLK, focuses on a specific industry, including tech-related companies such as Nvidia, Apple, and Microsoft. While ETFs can specialize even further, such as dividend or large-cap company ETFs, our favored type is the index fund. These ETFs encompass all stocks within a specific index, irrespective of individual companies. Examples of such indexes are the S&P 500 NASDAQ or Russell 2000. At Everything Money, our preferred ETF is the Vanguard 500 Index ETF, VO. Investing in this compilation of stocks makes you a partial owner of the top 500 US companies, mirroring the S&P 500. Index funds are exceptional because essentially you're investing in the entire market. You become part of the benchmark, eliminating the need to outperform the market, especially during a downturn. With these ETFs, you are the market, you're in it. The best part is, you don't need to take any action. Someone else manages all the investment decisions, updating the funds aligned with the specific index. If a company enters or exits the S&P 500, they automatically adjust the ETF composition. The beauty lies in the fact that you're investing in all 500 stocks, ensuring you get a piece of any changes in the fund. Additionally, you have the option to reinvest your dividends, facilitating the power of compounding over time. Wait a moment. You might be pondering if someone else is managing the fund and there are multiple stocks involved. This sounds a lot like a mutual fund, but exercise caution. They are not identical. Mutual funds have a paid fund manager who levies a substantial management fee, justifying it by claiming they actively manage with a research team, finding the best companies for you. Unfortunately, 82% of actively managed mutual funds don't outperform the market on a year-over-year basis. Over a 10-year period, it's in the low single-digit percentage. Take Meta stock, for example. It plummeted earlier this year. I'm sure mutual fund managers were selling it like crazy. Now, even though it's rebounded, they're contemplating getting back in. They missed out on an opportunity due to career risk. They couldn't be in a company that was plummeting drastically. Now, let's discuss ETFs. They are passively managed funds, making moves in accordance with their sector or index. They charge a minuscule fee compared to mutual funds. A typical mutual fund charges 1–2% of the money you invest per year. So if you invest $10,000 annually, they'll charge you between $100 and $200, whether the fund is up or down. For VO, it's 0.3%, meaning for every $10,000, it's $3 in fees, compared to $100 to $200. So if ETFs are so remarkable, are they superior to investing in individual stocks? Excellent question. I'll be straightforward with you. You won't achieve extraordinary gains from an ETF. That's not their purpose. An ETF, especially an index fund, is the best strategy for steady, long-term growth with less effort. However, if you can invest in individual stocks, chasing potential gains without a process, you'll likely incur significant losses. That's why ETFs are outstanding. Here's the bottom line. If you're willing to put in the work, hours of research, extensive reading, and learning a process for investing in individual stocks, go for it. But it's more than that. It's also about having the proper emotional temperament. Investing isn't just about numbers, it's about being different from the market. Can you buy a stock when it's falling? Can you avoid a stock that's irrationally going up? I love investing in individual stocks. However, if you want something that's less work, less risky in the long term, go with index funds and ETFs. The only process you need is buying month in and month out, investing the same amount each time. Sometimes you'll buy high, sometimes low. This process, known as dollar-cost averaging, leads to market-matching returns over time at 99.9%. And compared to significant losses, that's pretty good. So, which one are you opting for? ETFs or individual stocks? By the way, you can do both. I started with 100% ETFs, and as I gained more confidence, I transitioned away from ETFs, gradually moving towards more individual stocks. Let me know in the comments below. Regardless of your choice, check out our Stock Market Investing for Beginners video series to get started with both and begin learning. Thanks, and we'll see you in the next video.